At the start of the year, we talked about what a Trump presidency might mean for inflation, especially if tariffs materialized. Well, they certainly materialized. The question is now, does this evolve our thinking? The first half of 2025 has reinforced our view that we're entering a new investing regime, one defined by greater macroeconomic volatility, diverging economic and policy cycles, and far more interventionist governments than we've seen since 2008. But this isn't a clean break from one regime to another. It's a messy, transitional phase where some old rules still apply, even as new ones might be emerging. In biology, when the environment changes, species must adapt. To paraphrase Charles Darwin, it's not the strongest that survive, it's those who are most adaptable. In investing, when market regimes change, we must also evolve. Evolve our frameworks, evolve our assumptions, evolve our models. This is to ensure we're managing portfolios for the world we live in, not the one we lived through. I think the evolving market environment should prompt investors to rethink three key dimensions: diversification, income, and the public-private market divide. Diversification is being redefined. So for years, a US-centric equity allocation delivered strong results. But as the narrative of US exceptionalism is questioned, investors may wish to consider a wider opportunity set. Different economies might adapt at different speeds, with European and Japanese equities looking particularly attractive at the moment. US equities still play a very important role within portfolios, but we may need to think more carefully about how we allocate to them. Extended strategies are one consideration for investors who have concerns around concentration risk, for example. Income has always been a central pillar of portfolio construction, but given higher inflation volatility and a lower growth environment, we need to think about stability of income. That means focusing on pulling in income from multiple sources, including potentially alternatives. When trying to generate income in this new environment, we also need to be worried about the downside. Stickier inflation may continue to disrupt the traditional negative bond-equity relationship, and so consider leaning into more dynamic fixed income strategies, as opposed to the static ones that did so well after 2008. And then there's the public-private shift. More of the market is now private, as companies are staying private for longer. Private markets are starting to become an important consideration for a broader set of investors who are seeking to achieve multiple portfolio objectives, such as balancing returns, income, diversification, and inflation protection, alongside traditional assets. Within Wellington Solutions, we learn how companies and governments are adapting to today's shifting environment from deep research, especially through the firm's global industry analysts and macro strategists. Sitting at the heart of Wellington allows us to connect the dots and see where our human evolutionary advantage of innovation is happening in real time. When the environment changes, as this year demonstrates, companies pivot, technologies emerge, and investors recalibrate. Despite markets being really challenging, our long-term view is a positive one. We're optimistic because as humans, we have the ability to adapt and innovate.